We're looking at the Joyce Walker case study on portfolio management. Let's scroll down and start reading. Question 1. Based on the information presented in Exhibit 1, Morris's value investment style can most likely be classified as low PE, contrarian, or high dividend yield. Joyce Walker is a portfolio manager at South March Associates, an asset advisory firm. Walker is managing the equity portion of Lake House Limited Endowment's policy portfolio. The portfolio is currently invested in international ex-US equities and is being managed by 4 individuals: Gina Eco, Blake Morris, Carl Smith, and Mehmet Akhtar. Exhibit 1 displays details concerning the funds managed by the individuals. All right, so we've got Exhibit 1. This is what the information we were looking at. So we wanted to know Morris's value investment style, most likely. So we're looking at Morris here. So low PE, let's take a look at that first. He's at 14. Relative to this value manager, he's quite high, and then we're at 16.25. So it doesn't seem like he has a super low PE relative to the other managers. And then the other one was dividend yield. Dividend yield is also, it doesn't look like he's optimizing for that either. He's below the Akhtar, who's a growth manager even, and below Smith, another value manager. So it doesn't look like dividend yield is a focus either. So then let's look at contrarian. I'm going to cross these off since I think they're wrong, but let's kind of look at contrarian, see if we can justify that. So on contrarian, let's just go down the line, look at the stats. So we've got expected alpha, expected tracking risk, standard deviation, dividend yield, price to earnings, price to book. This is interesting here. So we're looking at a 0.7 price to book. A PE price to book below 1 suggests the market basically thinks these companies are worth less than the assets on the balance sheet. And typically that's only going to occur if the market thinks the companies have little to no future. So I think we could argue Morris is taking a contrarian style by investing in these low price to book companies. The market is pricing in failure, but he's investing thinking that they'll do well. So we will confirm and circle B, contrarian. Question 2. The manager that has outperformed his asset class benchmark by the highest margin is Morris, Akhtar, or Smith. All right, let's scroll up. So for this performance measurement, we're going to be looking at the annualized manager's return, and then we're going to subtract that from the manager's normal benchmark return to get our outperformance metric. So basically, we'll be taking, we're looking at these 3 managers. So we'll be taking 22.1 minus 18, 12.7 minus 13.7, and 17 minus 16.1. And then just seeing who has the highest outperformance. Let's pull that in right here. And we can see Smith has the highest outperformance at 4.1%. And we'll go with answer C. Question 3. To reduce the active risk in the portfolio, LLE will most likely increase allocation to Akhtar, Smith, or Eco. So active risk, if we want to reduce active risk of the portfolio overall, we're going to want to increase our allocation to the fund that has the lowest expected tracking risk. That's going to be that's what we're going to be looking at here. So our options were Akhtar, Smith, and Eco. So we got Eco, Smith, and Akhtar. So like we said, if we want to minimize tracking risk, or if we want to decrease active risk, we want to also minimize our tracking risk. So this is going to be allocating to a manager that is basically taking less bets relative to the benchmark. So we can see Eco has 0, Smith has 3.6%, and Akhtar has 8.1%. So Akhtar has the highest tracking risk. Eco is at 0. So what this means is it's an index fund. And so that's why all these benchmark returns are line up also with the manager's return. So we'll want to increase that allocation to eco. Answer C. Question 4. Concerning the benefits of a true misfit, distinction, Alexi is least accurate concerning justification 1 only, justification 2 only, or both of his justifications. So least accurate, so we want to pick the inaccurate statement or statements. We left off under the exhibit, so we'll start reading here. Walker's colleague, Levin Alexi, is reviewing the allocation presented in Exhibit 1. He tells Walker that a true misfit distinction between portfolio risk and returns is crucial. He supports his statement by providing the following justifications. So we've got our 2 justifications here. The true misfit distinction will allow for an optimized allocation to managers such that misfit risk is eliminated and true active returns are maximized. So this is going to be inaccurate. The distinction helps us to better understand our exposures and where we have misfit risk, but we're likely not going to be able to fully eliminate misfit risk, even if we kind of optimally allocate to certain managers, because all active managers are going to have some type of little minor style bias, and you're not going to be able to find an exact opposite style to kind of offset all those different managers. And they may change a little bit over time, manager to manager. So we're not going to be able to eliminate misfit risk, so we can say justification 1 is inaccurate. Justification 2, the distinction allows for the performance appraisal of active managers. This is accurate and is kind of the main reason for looking at misfit risk. It helps us better understand manager styles and whether the style is driving performance or whether they're actually performing well on a security selection basis. So we've got justification 1 is inaccurate, justification 2 is accurate, so we can cross off B and C, and we'll go with A. Justification 1 only, least accurate.